Hello everyone. Today's market looked calm on the surface. The S&P 500 closed almost unchanged, down just 0.01%, but underneath that quiet headline, there was a major split. Apple dropped sharply, Micron surged, mega-cap technology stocks weakened, chip stocks recovered, inflation moved higher, consumer spending stayed strong, and Europe closed at a fresh record high. So today's question is not simply whether the market went up or down. The real question is this: what part of the market is still strong and what part is starting to crack? Wall Street spent the session moving in two different directions. On one side, chipmakers staged a recovery after Micron delivered a very strong outlook. On the other side, fresh concerns around the largest market names pulled mega-cap stocks lower. The S&P 500 closed almost flat, slipping 0.01%. The Dow gained 0.1%. Nasdaq, according to before the bell data, fell 0.5%. But Bloomberg's Nasdaq 100 reading showed a 0.8% gain. That difference captures the main message of the day. This was not a unified market, this was a market full of internal divergence. The biggest pressure point came from Apple. All of the Magnificent Seven stocks declined, but Apple stood out. The company raised prices by 15% or more across Mac, iPad, home devices, and Vision Pro products. Apple linked these increases to persistent shortages in memory and storage chips. The market reaction was immediate. Apple fell 6.2%. This was not just a single stock move. It was also a reminder that even the largest technology companies are not immune to cost pressure, component shortages, and the challenge of passing higher prices to consumers. Apple was not the only company pointing to rising technology costs. Microsoft raised prices on Xbox consoles for the third time. That move became another visible sign of how component shortages are pushing consumer technology prices higher. So while the market still talks about artificial intelligence, chips, and data centers as growth stories, there is another side to the technology trade. The same supply pressure that supports chip demand can also create margin pressure, pricing pressure, and demand risk across consumer technology. That is why today's Apple move matters. It connects the chip shortage story directly to the consumer. But the other side of the session was completely different. Micron Technology jumped 15.7% after reporting strong quarterly numbers and giving an optimistic outlook. That move helped lift a key semiconductor index by 3.6%. This was important because earlier in the week, chip stocks had been hit by concerns that artificial intelligence valuations had become too stretched. Micron helped calm those fears. At least for today, investors were reminded that there is still serious appetite for the artificial intelligence story. The market may question valuations, but it is not ready to abandon the theme. The contrast between Apple and Micron also brought concentration risk back into focus. The equal-weighted version of the S&P 500 rose while the main index remained stuck. That matters. It means the broader market had pockets of strength, but the headline index was still being held back by weakness in the largest companies. This is the risk investors have been watching. When a small number of very large stocks dominate the index, weakness in those names can hide improvement elsewhere. Today, that is exactly what happened. The market was not weak everywhere, but the pressure in megacaps was strong enough to keep the main index from moving higher. The main macro focus of the day was the inflation data. Headline PCE, the Federal Reserve's preferred inflation measure, rose from 3.8% to 4.1% year over year in May. That was the fastest increase in more than 3 years and exactly in line with forecasts. Core PCE, which excludes food and energy, moved from 3.3% to 3.4%. On a monthly basis, the numbers were more moderate. Headline PCE rose 0.4%, compared with expectations for 0.5%. Core PCE increased 0.3%, matching forecasts, so the message was mixed. Annual inflation moved higher. Monthly inflation was more controlled. For the Fed, that is not an easy signal. The inflation data came alongside strong consumer numbers. Consumer spending rose 0.7% in May, above the 0.6% forecast. Personal income also rose 0.7%, well above the 0.4% expectation. This is a key part of today's story. Despite higher prices, spending remained resilient. And income growth also came in stronger than expected. According to Bloomberg, This keeps pressure on the Fed to hold interest rates higher for longer. At the same time, the recent decline in energy costs could help cool inflation somewhat in the coming months. So again, the message is not simple. The consumer is still spending, inflation is still elevated, and the Fed does not yet have a clean path toward easier policy. The growth data looked stronger at first glance. The third estimate of first quarter GDP was revised up to an annualized 2.1%. That was well above the 1.6% consensus and above the previous reading. But the details were less impressive. The personal consumption component inside the report came in at only 0.5%. The forecast was 1.4%. So while headline growth was revised higher, the consumer component looked much weaker than expected. That is an important distinction. The economy looked stronger in aggregate. But the source of that strength was not as clean as the headline numbers suggested. The housing data added another soft spot. New home sales fell 7.3% in May. The annualized pace dropped to 580,000 units. That was clearly below the expected 640,000. So the macro picture became even more layered. Growth was revised higher. Spending and income were strong. Inflation moved higher. But housing disappointed, and the consumption detail inside GDP was weak. This is exactly why markets are struggling to find a simple interpretation. There is strength, there is pressure, and there are cracks, all at the same time. In rates, short-term Treasury yields moved lower. The two-year Treasury yield declined by 2 basis points. Meanwhile, the VYX rose to 18.89. That combination shows a market that is not panicking, but is not fully relaxed either. Investors are still processing a difficult mix. Inflation is higher, spending is resilient. The Fed may need to stay restrictive. But parts of the equity market, especially semiconductors, are still finding support. This is not a risk-off market, but it is no longer a market where every part moves together. Outside the major index moves, company news was also mixed. Qualcomm rose after forecasting more than $15 billion in annual sales from artificial intelligence components in data centers by fiscal year 2029. Jefferies missed second quarter estimates as fees declined in its asset management arm linked to troubled auto parts supplier First Brands. Darden pointed to a cautious profit outlook after same-store sales at Olive Garden came in below expectations, even though the rest of the result was better. McCormick beat estimates thanks to higher prices and a tariff refund, and it reaffirmed its full-year guidance. So the corporate message was also divided. Some companies are benefiting from artificial intelligence demand. Some are dealing with weaker fees or softer restaurant sales. Others are relying on pricing power and specific cost benefits. Europe had a much cleaner session. The Stoxx Europe 600 rose 0.8% and reached a fresh record closing high. Technology stocks led the move as confidence in the artificial intelligence trade recovered. Chip-linked names, including Infineon and ASML, rose after Micron's results. So Micron's positive read-through was not limited to Wall Street. It also supported European technology shares. This is an important point. The artificial intelligence trade is still global. When a major chip-related company delivers a strong signal, that signal travels across regions. The biggest individual move in Europe came from Bayer. The stock rose by as much as 20% after the United States Supreme Court protected the company from tens of thousands of lawsuits claiming that Roundup weed killer should carry a cancer warning. That decision helps create a closing point in a decade-long litigation process that has cost the group more than $10 billion. Utilities and construction stocks also outperformed the broader market. Telecommunications and chemicals lagged behind. Bloomberg noted that after 3 months of underperformance, the Stoxx 600 is on track to outperform the United States index in June. That view is supported by the case for cheaper starting valuations and stable earnings growth in European equities. In commodities, oil recovered after 4 days of losses. According to Bloomberg data, West Texas Intermediate rose 2.6% to $72.15 a barrel. Brent gained 1.3% to $74.69. The move came after a cargo ship was struck in an unidentified incident in the Strait of Hormuz, and several freight vessels turned back from the waterway. This brought geopolitical risk back into the oil market. After several days of declines, traders were forced to reprice supply risk. Gold also moved higher after a volatile session. During local trading, gold slipped back below $4,000 as investors weighed the impact of higher United States interest rates, but it later recovered, rising 0.8% to around $4,029 an ounce. Iron ore moved in the opposite direction. It fell 0.7% to $97.70 a ton. So commodity markets also reflected different forces. Oil responded to geopolitical risk. Gold balanced higher rate pressure against renewed demand. Iron ore weakens. So what is the main message from today's market? It is not that risk appetite disappeared. It did not. Micron's surge, the semiconductor rebound, and Europe's record close show that investors are still willing to buy into strong narratives. But it is also not a fully confident market. Apple's sharp decline, higher PCE inflation, weaker housing data, and the rise in the VIX show that investors are still cautious. This is the key point. The market is still standing, but the leadership is becoming more selective. Not every technology stock is being treated the same. Not every strong economic number is good for equities, and not every index headline tells the full story. Today's market can be summarized in one sentence. The index looked calm, but the inside of the market was anything but calm. Apple showed the pressure, Micron showed the opportunity, PCE inflation showed the Fed's problem, Europe showed renewed momentum, and commodities reminded investors that geopolitical risk has not disappeared. Next, the market will turn to the University of Michigan Consumer Sentiment Index. That matters because consumer confidence will help shape how investors read the balance between spending, inflation, and growth. For now, the market is not giving one clean signal. It is giving several signals at once. And that is exactly why today's flat close may be more important than it looks. Which signal do you think mattered more today? Apple's sharp decline, Micron's artificial intelligence-driven surge, the rise in PCE inflation, or Europe's fresh record close? Write your view in the comments. Let's read the market together.